Is there a doctor in the house?
Doctor, you have a visitor in the main lobby.
Hello and welcome to the Talk to the Doc podcast, where we discuss opportunities and challenges that leaders face on a daily basis. Today, we're diving into why most owners still fly blind in their finances and how better visibility can change everything. I'm your host, Steve the Dr. Meek, and the doctor is in. Today's guest is Tyler Davis, so let's get into it. Welcome, Tyler. Hope everything's going good today. Can you share a little bit about some of your background with us?
Yeah. Thanks for having me on. I am a CPA. I actually started down the route of traditional, as you know, at CPA services, tax planning, some books and stuff like that. And what ended up happening is kind of as a request of some of my clients and just the nature of me loving business, I've moved much more into advisory for businesses around the kind of this topic, just financial clarity and trying to get an understanding of what is going on from the financial lens in a business.
Needed. Well, for today, I guess I'd like to just get right into it. But I do love that big picture view from above, and sounds like you also get down into the weeds of things just to kind of make sure everything is solid. But like every doctor's appointment, we got to start off with vitals. We got to understand a little bit more about what's top of mind. So the first vital I always like to hit, I call it the pulse. Can you tell me a little bit about the current state of the market or industry trends that you feel affect you?
Yeah, I think we're in a big phase of what's going on with AI and automation in the finance world. There are so many different software things that business owners can be tempted to try as it pertains to finance in their business, not just let alone like your general ledger, like a QuickBooks Online, but every industry now has some piece of software attached to it from maybe a client delivery, customer delivery standpoint, project management, banking, paying bills, who knows what, invoicing. And there's just a lot going on in the space and a lot of promises. And it's rapidly evolving.
So how do you, with all these things going on, all this emerging technology, how do you guide your clients through that, or how do you advise them to look at those things?
Yeah, I think it always comes down to what pain points someone may be experiencing. I always like to start there because there's no sense in chasing things if it's not solving some level of a problem or addressing some level of a goal. So I think that's always the best place to start. And then it's determining what may be a solution based on some of those problems.
Now, are there frequent flyers? Are there common issues that you see across your client base that you think are probably applicable to all or most organizations?
Yeah, usually it's the visibility thing. Usually it is maybe their accounting, their bookkeeping, whatever you may call it, is more of an afterthought. Maybe just there for taxes. Maybe they're using different sources to determine kind of the health of the business from a financial perspective. The one that I hear all the time is they just kind of look at their bank account balance to see how they're doing. Right. I mean, it's common because if things are disconnected or they're slow, like say it takes a couple months to get the previous month's financials, it's just by rights kind of what you have to do as a business owner is look at the bank account because that's what matters and what's real.
So I mean, in your head, how dangerous do you feel it is when owners really are just relying on the bank account balance over, I guess, actual financial reporting?
Yeah, I think the danger is not understanding what commitments you may or may not be making based on a bank account balance. A good story is, a business owner not necessarily accruing for services they have not done yet or products they have not delivered yet. What can commonly happen is that you may get a significant amount of sales or deposits or something like that, and you still have to deliver on those. And it happens in either service-based businesses with employees, you got to fund the employees, or in manufacturing or production related, you have to actually deliver the product. And what can very much happen is significant amounts of revenue, deposits could come in. You look at your bank, looks great. You make decisions to hire, you make decisions for capital acquisition, who knows what. And then later on, when you have to deliver on said service or product, the funds may not be there. And it can really, really create a struggle in trying to plan. And usually this happens when you're seeing some level of growth in a business, maybe it's unexpected growth, maybe it's intentional growth, but understanding what your commitments are as revenue comes in. And from an accounting standpoint, there are ways that's handled to help you understand what really you have earned and what's really there and available to deploy.
Gotcha. So in my head, I'm thinking, to me, that sounds like, at least from our business, the service delivery side, kind of our work in process, the stuff that we've got related to, hey, we put 30 hours into this particular project, kind of where we are, or on the service delivery side, maybe it's manufacturing or whatever. We've got these materials, we've got these products, we've got these solutions, and, there's costs and trade-offs, and they don't always line up in the same month or whatever, but recognizing those, being able to differentiate those to feel the accuracy of your bank account. Just because there's money in the bank doesn't mean all that money is there, that there's other commitments against it. Is that kind of what you're saying?
Yeah, absolutely. I mean, sometimes what I always call people, like, what is your zero, right? You could take on significant amounts of revenue, but you may have to treat that as essentially, held funds that can't be deployed yet because they're commitments that you are going to make in the future. Whether it's through employee time and hours, or it's through expenditures you must have. And the other thing too, what happens is if you haven't had a strong understanding of some of your margins, and you do experience some significant growth, you may not be making the cash flow that you maybe expected as well, and the margin's not there later.
Gotcha.
And really capturing that and understanding that as you go is critical. I think one of the hardest things as a business owner is understanding how to scale. Scale is so hard. When I say scale, I mean, as you grow from a standpoint of staffing and or capital acquisition, what is it the business can afford based on the margins that you're providing? What hidden costs are out there with growth, and how does that impact margins? It's a lot goes into that, and there is very much a sticking point I see very commonly with business owners that have a lot of owner involvement, and that transition to which they're hopefully not as involved in delivery of product or service, what costs that may have as they grow.
Yeah, I actually I interviewed with a company once, and I asked to see their financials for the past 3 years, and I know it's like this huge loss that on their and I'm like, so what was this about? Can you tell me a little bit more about what's going on? And he goes, well, I just assumed control of the company, but my predecessor, even though they lost money on every single transaction, they felt they could make it up on volume. And just the way he said it, it just really cracked me up. But I think he's really making the same point that you're making, of being mindful of those margins and understanding what you're really taking to the bottom line.
Yeah, absolutely. And there are multiple different ways to grow and to succeed as a business. And sometimes volume is the type of business where, that's how you make your margin. I mean, think about grocers, right? Like grocery is known for 1% margin. So volume's the name of the game. But in service type businesses, volume can be a death trap to a certain extent, because it just piles up the problems and there's not enough margin there to deal with the administrative load of a service-based business growing rapidly.
Yeah, in our industry, we have a term we call the payroll death spiral. So if you're not building solid, stable, secure systems, it creates a whole bunch of reactive work. When there's so much reactive work, you have to hire more junior people to keep up with the reactive work. So if you're not doing proper design, it creates this situation where you just keep having to add more people to where at some point payroll will kill you, because it really requires you take a step back and make sure the foundation is strong, build upon it, have a structured process for continuous improvement.
And what I normally see during the same timeline is some of these same problems fall over into the finance side. So sometimes business owners will have really decent clarity into their financials until this point, because you start adding team members, you start adding multiple opportunities for people to
Right.
spend, you're having a hard time understanding where costs should be allocated. What typically happens is someone is using an internal or outside bookkeeper, and the mountain of questions that have to be answered as a result of this to understand where costs go, because they're seeing, credit card statements, bank statements that show, all kinds of different vendors and costs. Are those overhead costs? Are those costs to deliver
Yeah.
the service or the product? Where do these go? And it makes it harder and harder to have the visibility and behind the margins. And you're just looking at a profit and loss statement that shows a bottom line, but you can't really get a story out of it to be like, why isn't it higher, or why is it where it's at? What area do we tackle? We don't know, because there's been so much volume now, and we haven't assigned it in different areas. Sometimes it can just sneak up on you through this process of
Yeah, I
growth.
mean that proper allocation gets hidden, and I think in our business that's always a challenge. As things have changed over the years, there's so many vendors, so many technologies. Our account has been with us a long time, but the line items look different. We can do our best at coding, but there's still a lot of Q&A that I have to have with my account just to make sure that things get allocated correctly, because it's so I mean, it looks like nonsensical language, to the layman's eyes, unless you're a subject matter expert in the technology. A lot of times,
Yeah, I mean, it's something as simple as, I'm sure, even like in your business or any of these, even mine, there's a certain level of software that we purchase. And it'd be important to understand, is that a software that we're purchasing on behalf of a client for a client? Or is that our software? Because one of those items is going into our gross profit margin to determine our first cut of our profit. And the other one's an operating overhead item. And when you're trying to plan and forecast, having an understanding of what your true overhead is versus what your kind of cost of services are is really important as you go, hey, what if we doubled in size next
sure.
year? How much operating overhead do we need? Does that scale or does it not? Is that stick right where it's at? How much goes up in these cost of goods sold and cost of services? Because those are the stories that you kind of want to pull
Absolutely.
out when you're trying to make business decisions.
That's smart. I like that. And I think I hear you kind of telling us that if you're just looking at your bank account as that bottom line, that's a little bit like checking your weight by how tight your jeans feel. Instead of stepping on a scale. It might work for a little while, but eventually the truth's going to show up, and probably at the worst possible time.
Yeah, I mean, I'll go further
Okay.
into it too. Is like you can be stepping on the scale every day and getting that number, but are you tracking your calories and your macros and your protein and
Yeah.
all of that? If you have goals, right, you want to
Yeah.
build muscle. Well, just stepping on the scale is not telling you if you're building muscle or losing muscle, but tracking your macros, getting blood tests, getting DEXA scans, any of these other things that are available to actually get closer to what is going on,
Your
you
actual
know,
full body
is
health.
what you want to enable. Yeah.
Awesome. I like that.
Trying to stay on trend with the doctor here.
Sorry, I'm always trying to. I guess I kind of got that name because I used to parallel a lot of what we do with physicians about being intentional,
Yeah,
being holistic, thinking all things through. It's not always a technology issue. Sometimes it's a process issue. Sometimes it's a people issue
yeah,
or whatever. So I got caught a lot saying, "Well, it's kind of like you're a doctor." Blah 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 blah. So eventually, when we started doing nicknames, they just started calling me the doctor. So behind the scenes, how the sausage is made. Anyways, let's go ahead and move on. Let's talk a little bit about the pulse. I think of the pulse as kind of the market trend, the industry trend. Uh, you know, talk to me a little bit about what's going on there.
yeah. I think the big thing, if anybody, like a lot of people are
Mhm.
QuickBooks users, right? That's a huge accounting software, and there's a lot going on with like updates behind the
Oh
scenes with
yeah,
QuickBooks and AI agents and this and that, and accountants are mad because they don't like it. I don't know what the DIYers think, but as an accountant, we get nervous because there are a lot of promises made with AI agents, these are things of that nature. And what I can tell you is that It can only do what it knows. And we've just had kind of some talking points about like properly allocating cost, and the tools are not quite there yet natively just in your ledger like that to be able to do that real well. So, while there is a lot of efficiency to be made with AI and automation, and I'm a big believer of it, and I have, you know, processes and procedures for that, blindly trusting that right now could get you in a messy spot just from an accuracy
Sure.
standpoint, from a balancing, from a reconciliation, and also just to get the level of information you really want as a growing business. You're just going to continue, and I'm sure you have experience with this too, continue to see a lot of promises as a lot of money is invested into the space, but just be very weary of all of these promises. There's kind of an AI everything right now, and finance is a big area it's getting hit.
Yeah, yeah, definitely. We're seeing it everywhere, and I think, and in our experience, the models still have to be trained. And at some
Mm.
levels, you could be using regression or whatever, training data to get there. But if you don't have that training data early on, it takes a while for the AI to really learn your business, your operations, your process, your system, your terminology, all of those kinds of things, and in our own engagements and stuff, or even just at a personal level. I've been using Copilot for a little over a year now. I think it's been. And when I first started using it, it didn't know anything about me. I would have to tell it things, and it would learn from my prompts, my comments, my kinds of things. Flash forward a year later, now every so often it'll just pop up something about me, and I'm like, oh yeah, we had that conversation before. Oh, we've done this, and it takes time for that AI model to learn. So there's a lot of dangers in just trusting, a lot of wisdom in your words to say, hey, even though AI is very powerful, and I'm a true believer, and I want you using this, make sure you're quality checking it along the way. And I'm sure for your, for even your role, it's the same thing with the accountant. The accountants doing things or making things happen, but having you as that external eye to come in and double check and review and say, hey, I know what you're doing here and it makes sense for your situation. However, across my entire client base, I've made this observation or I've seen this that might also factor into that decision.
What's been really interesting for me over probably the last year or so, I think there's been this expectation that, especially in the finance side of the world, that AI is going to come in and really help with a lot of the kind of grunt level day to day menial tasks. And what I found is that AI is not that great at some of the menial tasks right now, but it's actually really good at high level stuff. Like if you're a business owner and you're feeding it your P&L or some of your transactions and you're trying to game plan and really think strategically, great companion for something like that. It can be just this great kind of sounding board, kind of beat it up, talk through ideas. It can be very valuable there. But when it comes to an invoice coming in from Amazon, its ability to understand if that needs allocated to cost of goods sold or if it's an office administrative expense is really hard for it to understand that right now. So it's kind of a reverse of where I think we were
Yeah,
heading. I will say this, don't forget about automation. Automation can be very powerful at menial tasks, and it's not necessarily an AI or an AI agent. It's just the way you architect your systems, your tech stack, and all these things that talk together. There are still very powerful automation tools that can do that well, and it's not necessarily whatever large language model running it.
yeah, that's. I think that's very perceptive. I think in prepare for the podcast, I looked somewhere and saw something like 60%, 67% of SMB leaders don't trust their financial reports to reflect kind of that real time reality. And
Mhm.
if that's what leaders believe about their own experience, then AI just coming in and trying to figure it out, there's going to be some elements of error.
Yeah, absolutely.
So how dangerous do you feel it is when owners kind of start to rely on AI to get those things right? What are the dangers there?
Yeah, I think the big thing, because I use it all the time. I'm always pressure
Sure.
testing this stuff, just from a so I can help customers. I can make my firm more efficient. What I've noticed is that just kind of the baked in, built in tools will automatically categorize transactions. Will try to automatically reconcile accounts. And what I'm finding is that they're automatically categorizing things to incorrect areas. Things are not necessarily reconciled. Things not reconciling is a big deal, because the whole point about a reconciliation, when we say that, we're saying we want to compare what's in our ledger to a source document like a bank statement, is actually confirming that your statements from a total standpoint is accurate. If your bank account is not reconciled to your ledger, that's telling me that something's missing. Either revenue's missing, expenses are missing. We're seeing things get put to, you know, balance sheet accounts like an owner's draw. That's not an owner's draw, and it's an expense. I mean, you're talking that has tax implications, that has also compliance issues with, and also just the fact that you might be operating under false information, and you can make business decisions on inaccurate data. So there are some other products coming
Okay.
out, like AI native general ledger accounting softwares, and they're picking up some steam. A lot of money's rolling into them, and it's kind of only, you said it best. It only knows so much about you. Um, and only has so much information available to it. As a transaction comes in, it's getting that small snippet of what's in the bank memo or the credit card memo. And while it can be incredibly efficient and kind of done for you, it can be essentially just wrong. So, especially as if you have any layers of complexity, to your business.
So out of that, are you recommending that accountants or whoever that they are you suggesting that they kind of go through their managerial accounting process and looking for those trends? Or are you suggesting that they take their data and throw it into AI to quality check, the decisions that AI is making on, are things still in alignment? Is the coding correct? What are you advising there?
The thing that I'm kind of championing on advising, and what I work with most with customers, is kind of architecting what the financial tech stack is and looking for
Okay.
efficiencies. So like we want to enable and we want to use AI, and we know that it's going to get incredibly better every single month, every single year. What's important is if the whole stack of items that you're using can communicate effectively and get the details that it needs. And I can kind of give an example of that. I mean, a financial tech stack typically involves your bank, whatever bank you're using, right? Whatever you're using for spend, whether you're using, like an accounts payable tool, you're using credit cards, whatever you're using for spend. You have your general ledger, like a QuickBooks. These things all kind of talk together. And furthermore, a lot of times you have some type of project management
Sure.
tool or
Mhm.
customer delivery tool. Depending on the industry, a lot of times it might do some of the invoicing. It could do some of the change orders for customers. You can track all kinds of different things. If you build that intentionally, with very modern solutions, modern online banking, a modern ledger that's cloud based, a proper bill pay and expense management software. A lot of these are incredibly inexpensive, but stacking them all together and integrating them appropriately can do a lot from the automation standpoint. And there's a lot going into it now with AI. Some of these tools will let you upload an expense policy, and it automatically looks at expenses and compares it to that policy, and then helps code. But if you set that up appropriately, you can see a dramatic decrease in the complexity of all of these back and forth questions at the accounting end to get to um, a finished product that's accurate and actually tells the story that you want it to do. So that's where I spend a lot of time. There are, and just to drop a few nuggets, like there are tools like let's call it Ramp, right? Ramp started as just a credit card company. Now they have, credit cards for employee spend as well as bill payment
Oh,
processing.
okay. Nice.
The beauty of something like Ramp is that if you have employees or administrators using credit cards for spend, as they spend, It automatically looks into their emails to attach invoices, receipts, anything that it can find. If it can't find something, it's going to send them a text message or an email and say, hey, what was that for? Is there a customer related to this? And it's all integrated with your general ledger. So as people are doing things at point of sale or a point of procurement, the information is already automatically going into the accounting system. And it is more likely to be accurate because it's happening in real time. And it's not us trying to remember 30 days later what that spend was for. Those are the types of things, if it's well thought out and architect, it can be very powerful for a business owner rather than just turning on the new AI feature inside of QuickBooks.
Awesome.
Yeah.
That's smart. And that's exactly speaking our language, that, the whole integration, the technology alignment, making sure that you have one story, all your systems able to communicate with each other, as opposed to all these different silos of information that requires someone in the middle or something in the middle to kind of bring the story together.
Yeah, absolutely.
Awesome. Well, let's see. We've been through the pulse. We've been through the heart rate. I think it's time to go ahead and get on to the weight. I think of when I think of the weight, I think of kind of the strategy, the big picture trend. What are you looking at there?
Yeah, I think the first and foremost, we talked about it early, is that you need to be confident that you can make decisions based on your accounting reports. If you have just accounting reports just to get your taxes done, I think you're at a
Sure.
disadvantage, right? Accounting was created to tell the story of a business to the end users. Each statement that exists for a reason. And if done properly, it will tell you the things you need to do to make decisions about your business. Whether that means you need to do some changes in your codes and your charts of accounts to tell that story and how it's structured, but you should be able to use that to leverage it to make business decisions. You hear people talk about all the time, if you're in the space at all, business owners need to do cash flow forecasting and cash flow this, cash flow that. Heck, accounting has a statement for it. It's called the statement of cash flows. It already exists, but no one ever thinks to run it or look at it because they've never put any resources into understanding what it is and why. And this is the huge gap that small business owners have because, as you get up in size and larger in size, and a business can afford to hire a controller or have CFOs and things of that nature, lots of resources into complicated and sophisticated accounting softwares. These things start to show up because you have all these resources you can put into it. But there's this messy middle where it's really challenging to get there because there's no one internally that has the understanding of what accounting is designed to do. And you either have to do something in-house or use someone outsourced. And I think for leaders in that space, try to figure out what you're trying to know on a week-to-week, month-to-month basis that helps you make business decisions, and work with somebody to try to figure out how to get your financial statements to tell you that.
That's so true. And actually that strikes home for me just a little bit. We've been in business 25 years, and I didn't look at statement of cash flows until like 2 years ago. Now as part of our weekly sync with my accountant at our managers meeting, she's got like the 13-week forecast, and we're going through it. But the bulk of our existence, I never looked at the statement of cash flows because just trying to get the financials right. We've got a lot of leading indicator kinds of things in our business that we ascribe to just to kind of predict where we're going to be. But statement of cash flows, it wasn't until kind of that post-COVID time frame where I was just trying to be really, really mindful of cash.
Yeah, and there can always be, the other thing I hear a lot is the difference between my profit and loss statement says I made X, but I didn't add any money to my bank account. And it's like, why? I don't understand why. And I think that's where trying to use the resources of whatever you're using as an accounting platform to tell you that answer is important, because that work's already being done. You're just not seeing it. And you don't have to recreate the wheel to figure out why. It's just hidden somewhere on a statement of cash flows or balance sheet why that occurred. And just for the listeners' purposes, a statement of cash flows, what it does is it reconciles net income, right, net profit, to what happened at your bank. So it's going to tell you the story of why that happened. Either credit card balances went up or down, or you didn't really collect any accounts receivable. There's multiple different reasons. But the reason that statement exists is to answer that question of, well, I'm really profitable on paper, but I didn't see it over here. Why is that? And then understanding that will help you make business decisions to either say, "Oh, that was just a fluke. This is exactly why this happened. It'll be great next month." Or fundamentally, we need to collect sooner on
Yeah.
invoices because we're growing at a rate that we need more cash in the bank, or we need to leverage a line of credit for XYZ. Who knows what, right? But that's what starts to tell that story.
Gotcha. So are there structural changes that you're doing to the financials for that? Or are you just saying, hey, make sure you're doing a statement of cash flows as well as all the other things that you're doing?
Yeah. Natively, most of the time, if you balance your books through your general ledger, it will produce a statement of cash flows, and should be accurate as long as you're reconciling all of your accounts. I think most people just don't even think to pull it or look at it. So it's just maybe some education on why it exists. A big thing I like to do when I work with customers is I fully expect people not to have a fundamental understanding of accounting. So part of my job is to actually just translate those statements into real language that they can understand. So that may be me pulling in data from the financial statements and then translating it into something that's easier to understand. But the core of it does come from the quality that's happening in those statements, because that's the source of truth. That's where the real data is. So to me, I think it still comes back to kind of that financial tech stack. When we talked earlier about, well, what are the pain points, a lot of times I can find a solution to the pain point by using a product appropriately, changing products, whatever that may be, just to get information in a proper way to decision makers.
Gotcha. So out of that, I mean, can you talk a little bit more about the blind spots that owners, executive leaders need to be mindful of if they're not doing that today, so that they can understand what some of those problems would be that statement of cash flows would help them solve?
Yeah, absolutely. A lot of times it comes down to kind of kind of velocity of money, right? How money moves in and out of the business, in two main categories: your accounts receivable and your accounts payable. What do you know as a business owner your average time it takes you to get paid after you invoice someone? It's a really important number to know, because if you think that you are in a growth phase, it doesn't matter if you're making products or delivering services. You have costs that you have to put into that growth, whether to pay employees, to buy product, to expand. But then you have to understand, when does the money actually show up? Because you do in your accounting, you can invoice people left and right and show revenue on a profit and loss statement, but at the end of the day, when does it come in, right? And then those purchases that you're making or that pay you're giving to employees, how soon does that come out? Many times you'll find businesses are billing and taking 60 days to get paid, but then they pay all of their bills and payroll in 15 days. So if you're growing, think about that 45-day gap of things going out the door in expense, but revenue not showing up yet. And that can turn into kind of the snowball to a big nuclear event 90 days in, 120 days in. So having a strong understanding of kind of naturally, oh, it takes us 60 days to get paid. We're okay with that. That's an industry standard. Or, oh, we're not okay with that. We need to speed it up. That lets you help make decisions on how you time your expenditures, what type of negotiations you need to do with your vendors to make sure you don't run into a cash crunch, and maybe affects your hiring schedule and how much capital you need to have on hand to get these employees hired to deliver the said service or product.
Sure.
That's probably the biggest one.
I see the interrelatedness of that. The day sales are outstanding, kind of drawn out. Especially during a high growth period. I can definitely visualize, and I think in our industry we've seen that at certain times, organizations, ourselves included, where we got really successful and had like a high trend. And if you're taking on a lot of work, a lot of projects, and maybe it's delaying things, maybe it slows onboarding a relationship, maybe it slows a project, which further delays the cash flow because you're growing so fast. You've got to make sure that you're keeping accounting and operations, in mind, in line with each other, so that you can see the one's impact on the other.
Yeah, and there's so many hidden costs of this growth because you can't just hire people and then they fulfill at the whatever productivity rate you may have in your industry right away. So then you have these kind of hidden costs of getting people up to speed. Most industries you have additional sunk cost into new relationships with customers on product or service. There's always more, a little bit more upfront. So it's rare to ever see somebody go through like a significant growth phase and not have a cash crunch problem pop up somewhere because it's just kind of a perfect set of storms. And the issue can become if you just don't even know
Yeah.
why. And how do you make decisions as a result of that? And you're just not understanding it. You're sitting there going, my P&Ls tell me I'm making
Yeah.
money. Where is it?
Yeah. Look at us. We keep selling. We keep selling. Unfortunately, sometimes that growth can hide inefficiency. When
Yeah, that too.
maybe you bring in a new role. Let's say you bring in a new project manager. You bring in a new project manager, even if they're an expert at being a project manager, you have to break all your processes to introduce this new person who's got to redevelop those processes, the lines of communication, the flow, all of those kinds of things. And so until that all gets fleshed out, there's a huge inefficiency in trying to figure all those things out and make sure that they're in alignment and everything's working again.
Absolutely.
So for you, uh, where are you helping your client organizations with that when they're experiencing inefficiency like that or growing really fast? What's your go-to move? What do you come in and go, hey, you're growing really fast, things are great, but things aren't great. Let's talk about this. How are you getting there, or what are you looking at?
Yeah, I think that I like to reverse engineer the different kind of KPIs in our industry. Very common ones, clearly, like net profit
Mhm.
margin, right? Gross profit margin, operating, overhead, right? I like to reverse engineer those for growth. So I'll take where we're at right now. Are we happy with our numbers or not, right? But let's just say where we're at right now, we have a 10% net profit margin, we have a 50% gross profit margin, and we're putting out, another 40% to our operating overhead, right? Then we can start to model what growth looks like. And we need to have the conversations early because it starts to bring in the operational inefficiencies. Because what I tend to find is a business will say, we're going to add 10 new contracts, and that's going to produce this much revenue, this much in our, cost to deliver it,
Sure.
whether it's staffing or if it's product. And our operating overhead is not going to go up very much because we have all these sunk costs and we don't have any growth there. Boom, here's what we expect. And almost 9 times out of 10, there are operating overhead percentages they never expect because of the growth, because there's some new administrative
Yeah.
burden. There's some new, like you said, this project management, new project manager comes in, efficiencies break down, something breaks there. And then they have to make a strategic hire to get through that hump, and it erodes the profit margin. That's like the story I see each time. So I think really discussing what the roadmap looks like for growth and starting to do some of the forecasting and trying to think of what some of those roadblocks might be from an operational efficiency standpoint ahead of time is what's going to allow you to go, okay, is our pricing strategy correct then?
Sure.
It's a tale of truest time that solo operators and businesses can be so much more competitive with pricing because it's
Yeah.
just them. And then each time you scale up, you have to find either a better pricing strategy for margin to afford these necessary evils from an overhead standpoint, or deliver in a more efficient way. And just mind mapping that out. I'm not the one that can come into a specific business and tell them how to operate efficiently. But my job is to say, to protect these margins, you're going to either have to find it in price or find it in your overhead, and just know that they will pop up. Just the accounting gets more complicated. The marketing probably gets more complicated. The IT services. How are you going to get 12 new employees their devices ready to go? These problems pop up at scale that cost money.
Got it. So you're trying to help them understand where their profit's actually coming from so then they can operationally go back and figure out how to maximize that, how to improve that, where the barriers are, where the blockers are, all of those kinds of things.
Yeah, a lot of times people don't already have what their gross profit margin is, or what they most people have their net
Mhm.
profit margin because it's the bottom
Yeah.
of the line. They may not know what goes into their delivery of their services or products. They may not know their true like burden labor rate and their operating overhead. So we got to get to that point. We need to get their accounting structure to tell that story. So then we know what the baseline is, understand if we want to improve or change that irregardless, but then know, hey, we can apply these types of percentages moving forward. And does that work for where we're trying to go? Because a lot of times what'll happen too in this growth is it creates these new problems. And now you're like, I need a COO. I need an operations person because of all these problems. Well, an operations person doesn't produce revenue a
Yeah.
lot of times. So where do we find that based on these percentages that we established back here? How much in sales do you need to even be able to afford that position? You know, so establishing some of the KPIs and getting the accounting structure to assign costs in the proper appropriate places is a good baseline before this kind of
Yeah.
sneaks up and kills your growth, you know.
So what do you think surprises leaders the most when you take them through this process?
I would say that um, the hidden costs of growth always surprises them. I don't think they foresee the problems of scale. Um, things are just always a little easier and simpler when you're smaller and have a smaller team. And as those things break out, and I'm sure, this is probably the hardest task of running a business is getting, the customer delivery, client experience, all these things, just how we do business spread amongst a large team as you go. I mean, you're introducing lots of variables from HR issues to, what happens if an employee just isn't up to the standard that we have. How do we train these people the way that our core team knows how to do it and duplicate these things? And I think it all seems like, oh, I'll just double the amount of staff I have and I'll double the amount that I can deliver. And they never expect the problems that come up and the cost to addressing those problems because it usually means more
Yeah.
people.
Yeah, so it's easy to see it that way. Now, you'd as part of our conversation, you'd also briefly brought up. I think you briefly brought up pricing. Do you have like a pricing guidance that you can share with the audience?
Yeah. So, I mean, I think the hard part with pricing is, ultimately the market will bear what the market bears based on what you are delivering, as a service. Problems go away quickly if you can increase your prices, but we all know that you can't just like flippantly
Right.
increase your prices because you're not going to convert any customers. There's a certain market element to where you fit in that. Now, I think you do need to make a decision on, I think we talked about it earlier. Volume tends to mean you can compete at a lower price, and the way you get to profit margin is through significant amounts of volume. And then there's kind of the boutique side of things and saying we deliver an exceptionally better experience, an exceptionally better product. That's how our pricing is going to be delivered. And then there are costs associated with that. Understanding what type of business you are from a pricing standpoint affects how you spend money. If you're in the boutique offering, typically whatever you're using for your material or whatever staff you're using are probably at an elevated rate. They're more expensive, they're more quality. And then if you're on the volume game, you're trying to find the most inexpensive things possible. It's the tale as good as time is that, a lot of people complain about low quality things that they're buying anymore, but they're also buying their iPhone chargers for $5. And so like there's a model for everybody.
Sure.
And then once we establish what it is that you want to be, then we have to think about, does your pricing support what you want to be as a business? Because many times people will start a business saying we want to be the best, the highest quality, no one can be better than us, and charge the same thing as the high volume guy down the street. And that becomes a problem because there's not enough meat on the bone to do all of that quality because there's not, we just talked about, you kind of reverse engineer it. If you want a 15% profit margin, Okay, after your sales are done, now you have 85% less. How much does it take you to deliver? Is that 50%? Oh, now we're down to 35. You got 35% left to cover all your overhead. Can you do that? And that's where I think pricing strategy
Got
comes
it.
in. And it's not easy to just go up or down, but understanding what it is and what that affords you is important.
So figure out your strategy, whether you've got a premium offer or a discounted offer, stay in your lane. Just make sure that your pricing strategy matches your lane.
Yeah, absolutely.
Now, we haven't even we've been talking a lot about the financial side of things, the cash flow and things other than just profit. But we haven't even every business owner also has to worry about taxes. The tail that sometimes seems to wag the dog.
Yeah.
What's your advice about taxes?
Yeah. My advice is that you should really never be in a position where you don't have some general idea of what your tax implications are as you go. I mean, taxes for the most part are just a math problem, and you can have a running math problem all year. Do we have to get down to the nitty gritty of exactly what your taxes are going to be as a business owner? No. But if you're looking at your financials and you understand your ownership structure and whatever that is as, your piece of it, you should be having a running and understanding of what your tax will be every quarter and adjust based on, a lot of business owners are paying quarterly
Sure.
estimates, things of that nature. I always suggest kind of getting that baseline and being like, okay, let's just make up a percent. Let's just say, my effective tax rate usually is somewhere around 20%. Well, I need to understand that bottom line of that P&L every month or quarter, about 20% of that's going to be in tax. Am I paying estimated payments to keep up with that? We just don't want this big surprise come March or April that you didn't see coming, because business finance and personal finance are the same thing to a
Sure.
certain extent, because the owner's got to be able to pay for the taxes, or the business has to be able to pay for the taxes. And I think then, working with someone who has an understanding of how taxes work, whether it's an enrolled agent, CPA, whomever it is, there are advanced things they can do from a planning perspective to try to help you mitigate taxes. But at the end of the day, I will
Yeah.
always tell people paying taxes is a good thing. The biggest thing you should be focused on is increasing, your profit or revenue or whatever it is, because you're gonna reward yourself more in that angle. And then, start making decisions about what's efficient long term for tax. There are many little booby traps people can fall into with tax, especially with, you know, when the latest tax bill, when TCJA happened in 2017, and now that that's been expanded here permanently for a
Yeah.
lot of different aspects, a lot of people fell in love with bonus depreciation, 179 deductions, and immediately expensing very expensive purchases. People love it because they can wipe out their tax liability. And what it does, it kind of starts to put you on a hamster wheel. Because, normally speaking, if you go buy $100,000 piece of equipment, you're going to depreciate that property over the number of years that it should be useful to your business. And what that does is it matches the cost up with the revenue as you go along and kind of equalizes your taxes. If you elect to take a $100,000 deduction on that the year you buy it, you're probably going to have meaningful revenue in future years and nothing to deduct from it. So what I find the trap people get into is they're always looking for their next purchase to mitigate their taxes. And a lot of times they get into debt financing for it because they don't actually have the cash flow to outflow it. And they keep building up this payments, the amount of payments their business has to make to afford all this equipment. And none of this has been made as a decision on what would actually make the business more profitable or more successful. And it's just trying to chase down a tax bill,
Yeah.
and it's a very tricky trap that you can fall into.
Gotcha. So I just kind of want to make sure, because it's not matching to the period exactly. It's all being done in one period. Yeah, definitely. I can see that mismatch
Yeah,
potentially causing an issue.
yeah, sorry. Traditional accounting rules say, hey, if you bought $100,000, piece of machinery that makes your business money, it's probably going to make you money over so many different years, and that's how you normally deduct things. Now, Congress has passed laws that wants to incentivize us to make those purchases, and they say, hey, go ahead and write it off in year one. That could be great for you in year one, but problematic for you in the future years because you don't have those deductions anymore, and you have to find new ones.
Yeah, you call it a surprise. I guess I think of owner's taxes as kind of the only surprise party that you never wanted and still paid for.
Yeah, necessary evil, and it is very challenging for business owners to kind of wrap their hands around tax implications. Especially what I see is that transitional. You went from being an employee, now you're a business owner, now you're adding staff, and each step of the way, it seems very painful. Um, and I hate to see folks basically not have a good view. We talked about earlier visibility of what that is, and then it just show up and be this expense at the end of the year that they're just not ready for. When really you should be able to understand at least roughly what it's going to be on an ongoing basis and try to plan around that.
Gotcha. Yeah. Well, awesome. Well, Tyler, we had a lot today. We went through a lot of different topics, a lot of different things, but I'm the doctor. I gotta help bring it to a head and help you do that one thing that's most important. So, what would you say that we've kicked a few rocks around. I think you found some truth underneath all of those things. But when the spreadsheet closes, what's the one idea you hope stays with the leaders after we finish our conversation today?
Yeah, don't give up on your financial statements. If I hear a lot of people frustrated just because I don't get them until they're not done timely for me to make a decision. They're not really telling me the information I need to know. They just go to different places for the information, whether it's their bank, whether it's their CRM, who knows what, but they're going to different places. And I find that as a big risk because those other places are not reconciled to reality like your accounting statements are. And I think it's worthwhile putting some resources into learning a little bit more about them and also getting them to do some work for you in terms of telling you that story. Because you're looking at something that is vetted and has gone through the processes of being as accurate as it can be. Too many disaster stories of people looking in other areas and being blindsided by things that approach that they would have not known without looking at, say, their balance sheet.
Gotcha. Nice. Along with the big summary, I always like to help people get started. So if this was a proper doctor's appointment, you just gave us the home run. But are there other minor prescriptions, things that people should be doing?
Yeah, I think another simple one, we barely touched on it, but like get your tax situation under control. Don't be afraid of your taxes. Kind of be empowered by them. Work with somebody that will meet with you regularly and give you an understanding of what they are. I see tax kind of beat up business owners too often. And there are some really powerful things if your business does well to where you can mitigate that, or at least have it in your control, and not let it be a barrier of business ownership, business growth, all the things. It's just having someone that'll spend the
Yeah.
time with you and explain it to you. And it's one of those things is don't give up and just say I'm not going to understand this stuff. Like part of being a business owner or being a leader is that you got to be dangerous. Just know enough to be dangerous in so many different areas, and this is one of them. And I think it's really important to kind of have the steering wheel of your taxes and your financials, and not let it kind of control you.
Gotcha. Yeah, that parallels a lot. Being a good doctor, the worst feeling in the world is when you go in for your physical. They just take your quick blood check, talk with you for 2 minutes, and then kick you out. Do you need your prescriptions refilled? If you're really looking at the entire health, you want someone who's going to spend a little bit of time with you, understand, ask more questions, let you talk, all of those kinds of things.
Absolutely.
Well, if there's a way that people want to follow up with you or ask you additional questions, what's the best way for people to reach out to you?
Yeah, I'm pretty active on LinkedIn. So if you have a LinkedIn, look me up there. I mean, we could probably link it, but I post pretty regularly. I have a newsletter on
Oh, okay.
there. I'm always looking for, you know, meaty stuff that I can, put out for business owners that like, something that's tangible and real and advice things that I've learned over the years, things that I've seen. I think that's the best place to find me and reach out because I'm pretty active on
That's
there.
awesome. It's always good to give people free stuff. My audience always appreciates free stuff. In case you didn't know that. And we'll have your LinkedIn with the video when we produce that. For myself, you can always reach out to me on LinkedIn or via email at the doctor, all spelled out, at fulcrumgroup.net. I'm always excited to hear from people, hear ideas for topics, identify new guests, and those kinds of things. But hey, that brings us to the end of our appointment. We've had a great time today, and I think that if there's a theme that ran through today, I would say that clarity kind of beats guesswork every single time. Being specific, being intentional. Right. Leaders having the right systems, the right views of the numbers, and then the right partners or advice. That makes it easier to make better decisions. So if today's conversation sparked a few questions, don't forget, it's the first sign of progress. Be sure to subscribe to our podcast wherever you consume your podcast, and don't miss out on future conversations. I'm your host, Steve the Dr. Meek, and the doctor is out. Thanks so much today, Tyler. Great having you on.
Thanks.